Every major economic collapse in modern history shares one uncomfortable truth. The people who built generational wealth during those moments did not react to the crash. They prepared for it. And that single difference, preparation versus reaction, is what separates those who lose everything from those who multiply everything. For decades, the mainstream financial system has told you a very specific story. Crashes are unpredictable. Diversification is your only protection. And if you try to time the market, you will lose. Now, here's the part most people never question. That advice is not wrong, but it is not designed for everyone. It is designed for people who don't have the capital access or emotional discipline to play a completely different game, because there is another group, a quieter group, a group that doesn't panic when markets fall because they already moved before the fall even began. Their strategy doesn't start during the crash. It starts 18 to 24 months before it. And if you study history carefully, you'll notice something almost shocking. They follow the same patterns every single time. Let's start with the first asset, the most boring one. And ironically, the most powerful one, cash. Not just money sitting idle, but short-term government instruments, treasury bills, highly liquid, safe assets. Before major crashes, whether it was 2000, 2008, or even the early signals before 2020, institutional money quietly increased cash positions while the public chased returns. They built liquidity. And the media always says the same thing. They're being too conservative, they're missing opportunities, they've lost their edge. But what they're actually doing is preparing ammunition, because cash during normal times looks weak. But during a crisis, cash becomes power. When everything drops 30%, 40%, 50% cash turns into the ability to buy assets at prices that only exist during panic. The average investor sees a crash as loss. The prepared investor sees a crash as a discount window. That's the first shift in thinking. Now let's go deeper. The second asset is something most people don't understand at all: distressed debt. When companies start collapsing, their bonds crash in value. A bond worth 100 may trade at 20 or even 10. To the average investor, this looks like danger, but to sophisticated investors, this is opportunity. Because in bankruptcy, there is a hierarchy. Debt holders get paid before equity holders, and often equity holders get nothing, which means something very powerful happens. If you buy the debt cheap, you can end up owning the company, not by buying stock, but by stepping into control during restructuring. This is how massive wealth transfers happen quietly. Companies don't just disappear in crises, they change hands. And usually they move from the many to the few. Now the third asset. This one is ancient, older than stock markets, older than modern finance itself. Productive farmland. Think about this simply. No matter what happens in the economy, people still need to eat. Food demand does not disappear. Markets can crash. Currencies can fail. Banks can collapse. But human biology does not change. And that gives farmland something unique, a natural floor in value, because it produces something essential, not optional, not luxury, essential. Throughout history, whether in ancient economies, post-war environments, or modern crises, land that produces food has always retained value better than most financial assets. It's not just land, it's production, it's survival, it's demand that cannot be turned off. Now let's talk about something unexpected. The fourth asset blue chip art. At first it sounds strange. Why would the wealthy move into art before a crash? But the logic is actually very simple. True high-value art has three unique properties. It is scarce, it cannot be reproduced, and it does not move with stock markets. When financial assets become unstable, money looks for stability, and scarcity becomes incredibly valuable. Unlike stocks or currency, you cannot print more of a masterpiece. Supply is fixed forever. And that creates a different kind of protection. It's not about beauty, it's about scarcity and independence from financial systems. And here's what's even more interesting. Many of these transactions happen privately, not in public auctions, which means pricing, discounts, and deals are often invisible to the general market. Now we come to the fifth and most powerful asset. This is not defensive. This is offensive. This is where fortunes are built. Essential service. Businesses. Think about industries like waste management, storage, water supply, funeral services, basic infrastructure. Not exciting, not glamorous, but here's the key idea. People cannot stop using these services, no matter how bad the economy gets. Even in a recession, garbage still gets produced, water is still needed, storage is still used, life and death still continue. Now combine that with a downturn. Small businesses in these sectors struggle. Many go bankrupt. Assets get sold cheaply. And large, prepared capital steps in. They acquire these businesses at discounted prices while the cash flow remains stable. This is where real wealth expansion happens, not by chasing trends, but by owning necessity. Now step back and look at the bigger picture, because this is where everything connects. Crashes are not just random disasters. They are transfer events. Wealth moves from those who are unprepared to those who are prepared. From panic to patience. From reaction to strategy. And the most important part is this. The system doesn't hide this. It simply assumes most people won't act on it. Because acting on it requires patience, discipline, and thinking differently from the crowd. So what does this really mean for you? It means you don't need billions to understand the pattern. You don't need access to elite institutions. You don't need insider connections. What you need is awareness. Because once you see the pattern, you can't unsee it. Cash becomes optionality. Assets become tools. Crashes become timing windows. And suddenly fear starts turning into strategy. Now think about this carefully. If the next crash is not a question of if, but when, and if the signals always begin months or even years in advance, then the real question is not, will a crash happen? The real question is, will you be ready before it happens? Because by the time the headlines appear, by the time panic spreads, by the time everyone starts reacting, the positioning phase is already over. So where do you want to stand? With the crowd reacting late, or